Today we're going to talk about how you can pay off a mortgage in 5 to 7 years while also saving six figures in interest and set up a tax optimized pension fund for yourself without sending more money to the bank. Okay, so let's talk about this. Here we've got a person who's got $650,000 mortgage, $650,000 home value at 6% interest. They borrowed $500,000. Basically, they're going to have a principal and interest payment of about $3,000 a month. Okay, so they do that for the first year of having this mortgage, so 12 months. And now they've spent $36,000. How much do you think their mortgage balance is at the end of the year? I'm sorry to tell you that if you do the math, the balance on that mortgage is $493,000. Okay. Now, they've also got this savings account over here as well as this checking account. Now, I wrote surplus because at the end of the year, they're saving about $20,000, which they then stick into their savings account. That's saving about $1,600 a month. Again, these are just sample numbers. Don't read too deeply into it. So we have this divide over here between the mortgage and between the banking, right? We got the banking side over here, mortgage over here, and these two things, they really don't speak to each other. One doesn't help the other, right? You're going to get a bank statement, show you the little bit of interest you made on your savings account, and you're going to get a mortgage statement showing you what your next payment is and what your balance is, etc. These two worlds are completely separate. But wouldn't it be nice, of course, if we could somehow merge them and we could get benefits from merging them, right? Well, the old-fashioned way, of course, is to take this savings account and to move that money over here to your mortgage to pay down your mortgage. But typically, I get people telling me about two reasons keep them from doing that. The first reason is they don't get the benefit they truly want for sending over that $50,000, and that is they don't get a lower payment. That's what people would really like, right? If I send that $50,000, what I'm going to get is this will turn into a $450,000 balance. However, the payment next month stays the same. Payment doesn't drop down at all. Why? It's contractual. It's already set up with the mortgage. That's what the payment is. What I do get is I'm going to be able to move my 30-year mortgage and change it into a 23-year mortgage. Now that's nice and all, but a lot of people don't feel really great about sending $50,000 today to their bank to get a benefit in 23 years from now. So that's the number one reason people don't send this money over to the bank. The number two reason is because people are worried about a rainy day. So for example, what if someone loses their job? Suddenly now they need that savings to live on, or there's some other emergency and they maybe need to pay some medical bills or make a deductible towards their home or maybe their car insurance, right? So they're worried about a rainy day. If that $50,000 is over here in the mortgage, like we said, giving that person a benefit 23 years from now, but today they have an emergency, they're feeling really bad about sending that $50,000. It's trapped in their house, mortgage, however you want to look at it. Basically, the only way to get that money out is either sell the house, which they usually don't want to do, or to do a refinance. And if you want to get a refi and you just lost your job, the chances of getting that refi are super slim, right? So this wall between these two worlds stays pretty solid, and there's really no breaking it without taking certain risks on. Except what I want to talk to you today about is another option, and that is called an MFL loan. An MFL loan does many things, but one thing it does is it merges all of these accounts. It merges your checking, savings, and mortgage account. So let's see what that looks like. So with an MFL account, we're taking these three things and we're putting them together. Okay, so one starts to offset the other. So if I got $50,000 over here, right away, I get the benefit on my mortgage. One offsets the other, right? And now I have a balance of $450K right away. I also get that number one benefit I wanted, which is a cheaper payment next month. So right away, I'm getting the benefit of that $50,000, giving me a benefit today, or you could say next month. I'm saving $50,000. I'm using that $50,000 to save me some interest and make my payment smaller. Now, we talked about what if that $50,000 is over here and suddenly I need it back over here in my checking for an emergency. Well, the MFL loan, like I said, it's a checking, savings, and a mortgage account all in one. The nice thing is if you need that money, just like a checking or savings account, when you need to draw that money because you need it, can you take it? Sure you can. Same thing here. You can move that money to your checking account, use it to pay for whatever expenses and bills you have. There's no problem. The only thing that will happen is before you had a lower payment, and now your lower payment will just go back to being the payment it was before. You're just going to have payment, right? So that's the only difference. So maybe you were going to pay off your mortgage in 5 years. Now, because of this mishap, it's going to take you 6 years or so because you had to pay for that rainy day issue. But the good news is you're still going to pay off that mortgage in record time, certainly a lot better than 30. So this is one advantage of the MFL loan, and there are more. Like I mentioned, the tax optimized retirement, but this is a good start in understanding how you can pay off a mortgage in 5 to 7 years. So if you'd like to figure out if you can qualify for this mortgage, here's the kind of things I need to know. First of all, what state is the property in? Okay. I need to know things like what's the estimated home value, the mortgage balance on it, current interest rate, and what is your monthly payment. Now I'm asking for your principal and interest as well as the taxes and insurance over here. Okay. Then please let me know the years remaining on your mortgage. Now, this is the key because this whole system works because of positive cash flow. Okay. We need to be making steady progress on bringing that mortgage payment lower and lower and lower every month or at least every quarter. So what's important for me to know is what is your take-home pay, right? After taxes and withholdings, what are your monthly expenses? And what I really want is that pretty consistently every month or at least every quarter, you can say, hey, I've got positive cash flow, right? The bigger, the better. And then lastly, because this gives you a nice head start, any liquid savings, money market accounts, savings accounts, those things like we used in our example before of the $50,000 savings, that's going to jumpstart the whole program, get you a nice head start. What I'd like you to do is compile that info, look at your mortgage statement maybe, and then email me over here, Aaron at the KHA Group, Aaron at KHA Group, and send me an email with that info, and I will be able to let you know that you're hopefully qualified for this mortgage.